Okay, so this is really not that hard. Um, so like this might not be a mistake, as in like the company might be using an FOB shipping point, as in like the moment the inventory leaves the warehouse and is loaded onto the truck, they're gonna consider that part of the inventory. Um, so like what that means is the inventory would be actually correct, but the ending inventory, because like there might be inventory in transit, so like the inventory count would be incorrect because they're not going to count it in the ending inventory if they're using FOB method. So like for example, um, so like this would be correct. Like 50,000, 100. Let's say like the purchases are correct, 150,000, 50,000. That's actually correct, but the ending inventory um, is not correct. So like actually, what's in the warehouse is only 100,000. That's actually going to be the correct amount. But um, and like, but not in the ending inventory. So it's not counted in the ending inventory. Um, so 100. So what is the effect on the current ratio? The ending for not affected. Uh, the recorded amount would be 100,000. They should actually include this. That's the thing. They should actually include that in the inventory. But they're not, for whatever reason. So, um, so the ending inventory would be understated. Yeah. So like because they should be they should be recording it in correctly in the ending inventory, but they're not. Um, so like if it was correct, it would match the purchase amount, but it's not. The recorded amount was not including the inventory in transit. So like that would mean that, well, first off, cost of goods sold is gonna be overstated. The expenses have been overstated, so the income is going to be understated. Ending inventory is actually understated, and the current liabilities is no effect. Working capital, if the current assets understated, because it doesn't match the current liabilities, the working capital would actually be understated. And the current ratio was not going to be understated as well. So the beginning inventory is no effect, purchases not affected. Ending inventory is understated. Cost of goods is overstated. The net income is understated, as well as the current ratio would be understated. Okay, a company uses the periodic inventory costing system and has calendar year end. The company starts the year with the beginning inventory that's the beginning of the inventory is understated, but there's no other errors in the year. So what is the effect of inventory error on the net income for the calendar year? This one's kind of different. So like, if it was correct, let's say like it should have been 100,000 plus like the purchases of 100,000, and like let's say the net ending inventory is 50,000. But what was actually recorded, because the beginning inventory was incorrectly recorded, so 100,000 plus 100,000, 150,000, 150,000, cost of goods sold, 50,000 plus 100,000 minus 2,000, 100,000. So what that means is that the cost of goods is actually understated. Because like the cost of goods should be 150,000, but it's actually recorded at 100,000. So it's been understated. It's recorded as less than what it should be. So if the expenses are understated, the net income is going to be overstated. And then whilst the retained earnings, stockholder equity, the ending inventory actually has no effect. Purchases no effect. So the current working ratio and the current ratio is going to be, there's no effect to those. So what's the effect on the company's net income? The net income is going to be overstated. Okay. So a company uses the periodic system. The ending inventory is overstated. So some of these are pretty easy. The company's ending inventory is overstated. So like if it was correct, right? Let's say if it was correct, like the beginning inventory is 100,000 plus the purchases 50,000. Let's say that ending inventory should have been 50,000, but what was actually recorded was 100,000 for beginning inventory, 50,000 for purchases, and it's been overstated by 12,000. So like what was actually recorded was 62,000. So then, was correct. The correct amount should actually have been 100,000. That's cost of goods sold should actually be recorded at 100,000. But like what was actually recorded was 88,000 for cost of goods sold. So the cost of goods sold is actually understated. So if the expenses are understated, then it comes to be overstated. Shareholder equity, ending inventory is actually overstated. Purchases is no effect. Okay, so like if the current assets are actually overstated, then the working capital will also be overstated. As well as the current ratio. Okay, so what is the effect of this misstatement on the company's net income? Net income is going to be overstated. 2019, 2020. The ending inventory is overstated. Purchases most likely are correct. From what I can, you would think that possibly the ending inventory would also be overstated. Actually, the ending inventory might actually also be overstated. Right? That's over. That's the ending inventory. Okay, so the ending inventory is incorrect. Well, that means that in the next year, the beginning inventory would be overstated as well. So like in the next year, because like the beginning inventory was, because it's, well, cost of goods is understated. So like this, it should have been like the next year, the beginning inventory should be 100,000, but it's been recorded at 88,000. So like the next year, the beginning inventory will actually be understated. If that makes any sense, I know it's like super confusing. Um, so like this is the first year. So like the next year, the beginning inventory um, is actually understated, right? So like what should have been correctly, like let's say the correct amount should have been 100,000, but instead what was actually reported was 88,000. So it's understated. So then, like let's say again, it's like yeah, um, you know, like let's say the purchases was 50,000 again, and the ending inventory is like 50,000. Oh, that's correct. But like what was actually reported, so like for the next year, because of that understatement in the beginning inventory, the cost of goods sold for the next year whoops. Gosh. I mean, it's not super difficult. Like once you guys like might wrap your head around inventory. Um, Although I gotta say it is kind of yeah. So like what that means is that the beginning inventory for next year will be understated. Okay, the beginning inventory uh, will be understated, as well as the cost of goods. The cost of goods will also be understated. So both years will have be understated. But 2019 is overstated. Reported 80,000. Oh, net income. Oh, okay, it's the net income, yeah. So like the net income cost of goods sold was understated. Overstated. Well, I mean, the thing is, if the beginning inventory was understated, then it is safe to assume that the ending inventory would also be understated, unless unless I'm wrong. Uh, it just makes it be even more understated. Cost of goods sold is understated. Yes. Why would the second year be overstated? Or understated? Right. Oh, sorry. Yeah, sorry. This is cost of goods sold. So this would actually be was actually reported would be 62,000. Um, so 62,000. Actually, what would be correct is that 50,000 should be correct. Uh-huh. So then, 50,000. So okay, so like the next year, the cost of goods sold would actually be overstated. So then the net income would be understated. Okay, let's just try the rest of these because there's only a few left. So a company underestimates its ending inventory for a year. Oh man. Okay, so like, yeah, this is correct. Ending inventory was underestimated. So like the beginning inventory of 100,000, purchases 50,000. If it was correct, let's say it was like 50,000, but was actually reported 100,000 plus 50,000 purchases, underestimates its ending inventory. So like that means that they understated it. So like 30,000, let's say they reported it at 30,000. So what that means is that well the cost of goods would be 100,000 and reported would be actually 120,000. So cost of goods would be overstated. Okay, cost of goods overstated, but the net. So the net, if the expenses are overstated, the net income is understated. The ending inventory is understated. The liabilities purchases no effect. If the current assets are understated, the working capital is going to be understated, as well as the current ratio. So what effect does this have on working capital and current ratio? Understatement of working capital and current ratio. Oof, man, this is not super easy. I mean, it's not that hard. The company overestimates its ending inventory. Wait, did we just do this? Oh, they underestimated. Now they overestimated. So like, let's say the correct amount was 100,000 for beginning inventory. They purchased 50,000, but then they overestimated the ending inventory. So like, let's say it should have been ending inventory should have been 100,000 or 50,000, but they overestimated it. So they estimated it at 80,000. Let's just say. So like, the cost of goods sold would be 100,000. but the cost of goods sold, which was actually reported 70,000. So cost of goods sold has actually been understated. So if the expenses are understated, then net income is going to be overstated. Net retained earnings, stockholder equity, ending inventory actually has been overstated. Purchases have no effect. So if the assets have been overstated, working capital can be overstated, as well as the current ratio. Okay, so it's going to be overstatement of working capital and current ratio. A company that is using the periodic inventory system correctly records purchases but double counts some items in the ending inventory. Okay, so like what should have been correct is the beginning inventory is correct 100,000, let's say. So purchases 50,000, correct. But then they should have put 150,000 for ending inventory, but they double counted. So instead of the beginning inventory 100,000, purchases 50,000, and instead of 50,000, they double counted it. So now they counted it as 100,000 as an ending inventory. So the cost of goods sold would actually be understated. Cost of goods sold would be understated because it should be 100,000, but they recorded it as 50,000, so it's understated. If the expenses have been understated, the net income would be overstated. The ending inventory is overstated. Right? The purchases are no effect, correct? So if the current assets are overstated, the working capital is overstated, the current ratio is overstated. Woe at the end of the period. So cost of goods sold would be understated, that's correct. Okay. Next question. A company that is using the periodic inventory system correctly reports ending inventory but double counts on purchase items. Okay, so the correct amount should be 100,000. Let's say any purchases was 50,000. Ending inventory, they recorded it correctly with ending inventory. So ending inventory, because if it doesn't say so, then you can assume that it's going to balance each other out. So what was recorded at 100,000, they double counted some purchases in inventory, some purchases. So let's just say 75,000, and then 50,000 for ending inventory. Because ending inventory was actually correct. So 1,000 and 90,000 plus 75,000 and 50,000, 125,000. So the cost of goods sold is overstated. The net income, if the expenses are overstated, the net income is going to be understated. Retained earnings will also be understated. Current asset, the ending inventory, no effect. Purchases have been overstated. If the liabilities are overstated, the working capital should be understated. And let's see, what is that? Ending inventory. So it's going to be 1,000. Oops. 50,000 ending inventory divided by purchases 50,000 versus ending inventory 30,000 divided by 50,000. So the ratio is actually going to be understated as well. So what would the effect be? Cost of goods will obviously be overstated. The only thing you guys could like memorize this, but the failure to record a purchase of merchandise on account, even though goods are properly included in the physical inventory, as in like the ending inventory. Um, so like the correct amount, like let's say 100,000 in inventory plus 50,000 purchases minus like 50,000 ending inventory that was recorded was 100,000 beginning. So they failed to record purchase. So it should be 50,000, but they only recorded like 40,000. But then they recorded it correctly at the ending inventory. So that means that cost of goods sold is understated. If the expenses are understated, the net income is overstated. The ending inventory, no effect. Purchases have been understated. And if the current liabilities are understated, there's going to seem like there's more capital, so it's going to be overstated. As well as the current ratio. So the failure would an overstatement of assets. No, there would be no effect on the assets. Understatement of assets, no. The understatement of cost of goods sold. Well, yeah. And liabilities. Liabilities would also be understated. And an overstatement of assets, no, because it would not be overstated. An understatement of liabilities, yes, an overstatement of net income. So I believe this might be the last question, or not. Okay, so that's like a really big part about inventory. This is like a really huge major thing about inventory. This misstatement of um, inventory. So company receives merchandise on consignment as of 31. The company recorded the transaction of purchase on the account, include the goods in the periodic. The effect of this. Well, they recorded the transaction as a purchase on account, included the goods in the inventory. Consignment. I think that's like a separate thing. They don't actually own that inventory. They included the goods in the periodic inventory. So, like, if there was beginning inventory, would it be affected? They recorded the transaction as purchase. They don't actually own that though. Include the goods in the inventory. They want, like, they included it. So if a company includes the goods as inventory, that's incorrect because it's on consignment. because they don't actually own that. So they wouldn't have to even record that as a purchase, actually. Like, for example, like, let's say the beginning inventory is correct, 100,000. But they, what's correct, consignment, they don't actually purchase it or own it. They just sell it for a third party. So, like, let's say this is the correct, that's what it should have been. But instead, they recorded this. They recorded the transaction. So, like, let's say 60,000. And then included that in the periodic system as well. So, like, the ending inventory is going to be incorrect as well. But the thing about this is that they've overstated not only the purchase, but they've also overstated the ending inventory. So the cost of goods sold will not change. So there's no effect on the cost of goods sold. So there's no effect on the net income. But it's still incorrect because the ending inventory is actually overstated, and as well as the liabilities are actually overstated. But the working capital is going to be overstated for assets and liabilities by the same amount, so the working capital has no effect. But the ratio, on the other hand, I guess the ratio has no effect either. Normally, it should have an effect on it. Sometimes it does, sometimes it doesn't, I guess. Purchase on 6,000, 10,000 purchase, and then I got to. Yeah, well, the current asset and current liabilities are overstated. Okay. So, like, this is the last question for the misstatement of inventory. A company recorded the purchase of 500 units on December 28th. Year 1, free on board, shipping point. The units were shipped immediately and expected to arrive on January 3rd. Year 2, the company did not include these units in December's ending inventory. Okay. What effect does this have? Okay, so year 1, the correct amount should have been, well, they have like a beginning balance, and then let's say they have purchases. So they recorded this purchase, but they didn't include it in inventory. So like they recorded the purchase. So like what should have been correct, because did they record that? I don't know. Did they record that? Okay, so they were supposed to record that. For FOB, it is supposed to be recorded. If it's on consignment, it should be recorded. If it wasn't recorded, it's been overstated. So like, let's say 50,000. But they did not include it. Should the FOB be included in inventory? Okay, so FOB should be included in inventory, but it wasn't. So what should have happened, they did record. They did record the purchases correctly, but they didn't include it in the ending inventory, but they should have. So like there's two things, consignment and FOB. On consignment, they should not be recording it for purchases or ending inventory, and FOB they should be recording it for purchases and as well as ending inventory. So then that would mean that the cost of goods sold is overstated. So expenses are overstated, so net income is understated. The ending inventory is understated. And the purchases no effect. If the assets are understated, the working capital is understated, most likely the ratio is also understated. So, well, the inventory is obviously understated because the inventory has not been recorded. It should have.